Hey guys, and welcome to today's video. So in today's video we're going to be discussing market structure and liquidity. So market structure is basically a series of higher highs and higher lows in a buy trend formation, or a series of lower highs or lower lows in a sell trend formation. While liquidity, on the other hand, is simply a previous high or a previous low, or a series of highs or a series of lows, also known as double tops or double bottom, in a given price action. So how can you profit from this? First, I want you to understand that the movement of price is not random. Rather, every movement in price action is predetermined and simply has one goal or purpose, which is a reach for liquidity or a liquidity grab. So when you look at price action in a buy trend formation, price is simply in reach for liquidity, which can be a retest of previous highs as an area of support, because people who failed to get in on the first rally are now willing to join in the trend so they don't miss out. Hence, liquidity is provided at that area and price rallies again. But to where? Somewhere random? No, but to another area of liquidity, which is now on the buy side. This can also be said for the sell trend formation too. So let's see some examples to drive this home. So right here on the GBP AUD, you can see even with the current price action, price had the first rally to the buy side after running liquidity. On the sell side right here, we had a rally to the buy side, and you can see price had a little retracement. But the question is to where? So an area of what? Of liquidity, which is this previous high. So price retested right here, and what can you see? You can see a push to the buy side right there. So you can see how effective this is. And if you had probably entered at this particular weak rejection right here, you would have framed your stop loss below here. That will be 30 pips or 38 pips. That's 387, and you'd have been currently making over 700 pips. That will already be a 1 to 2 weeks to reward just by understanding market structure and liquidity. So I have another example right here I marked out. So let's see this one right here. This is also for a buy trend. We can see that this low price failed to take out this low, so this was a failure swing. But what happened? We saw the first rally to the buy side. So a lot of traders failed to get in on this first rally. So where would they be to get in, to join the trend? If this trend is supposed to continue, they're going to be right here at this previous high or this previous high. And you can see where the price retraced to. Price has exhausted the whole buy move here, so they needed more liquidity. So what happened? They came down to the sell side to get that liquidity. And where is that place? The previous highs right there. And what happened? You can see the rejection in price at that zone. So let's say you entered on this candle, placed your stops below that low. That'll be 465 pips, and you're aiming for that particular high. That'll be 761 pips. So that'll be a 1 to 1.8 risk to reward right there. So you could actually frame this further if you trade from the, if you refine this to a lower time frame actually. But this is how market structure and liquidity actually plays out. So looking at this example right here, this is for a sell trend formation. We can see we had a first rally to the sell side, and price retested this particular zone, which is a previous low. Mind you, I said previous highs and previous lows are areas of liquidity in a market structure. So because those are areas that those that fail to get in on the trend will seek to re-enter and join that particular trend. And you can see price retraced aggressively. Look at the aggressiveness of this bullish candle right there, all the way to where? The previous low right there. You can see the swing low right there. For those of you wondering, let me zoom that in properly. You can see the swing low. There is a swing low. That's the swing low right there. So price retraced deeply into it, and you can see the rejection of price all the way to the sell side. So if you had framed your entry here, putting your stop loss above here, that'll be 180 pips, and you'd have been taking out your position right here at 400 pips. So that'll be a 1 to 2 risk to reward. And if you had framed it properly, you won't get wicked out at this particular area, because price has completed the second move to the sell side. So for more examples, let's see more right there. If you see here, this is also for a sell trend. So we saw that we had a first rally to the sell side, and price retreats again to where? A previous swing low. You can see it right there. So price retested at a zone. What happened? We start seeing price drop aggressively. So you could enter on this candle right here. putting your stops above there. That'll be 480 pips right there. And you can hold all the way to the sell side right there. So that'll be 1,641 pips. That's already a 1 to 4 risk to reward ratio. So you can see how the market structure and liquidity is actually helping and playing out effectively. All you have to do is to be patient to be able to frame this risk to reward properly. So the next one we have here is another sell trend formation. Example, you can see we have a sell right there, first rally to the sell side, and these are series of swing low. All we saw is price came back, retested that zone, and we had our entry formation here, putting our stops above that high and holding all the way to the sell side. So our stops are around 250 and we are aiming for 100 and sorry, that's 1,300 pips. That's over 1 to 5 risk to reward ratio. So you can see how with the examples I have given and with the explanation, you could profit just by understanding market structure and liquidity. Now, I told you that price is not random, it's actually reaching for another area of liquidity. So if you look at this particular example right here, I know a lot of you would have been wondering about this particular high. Now, once we get wicked out, the point is that if you frame this particular setup properly, right here, as it came to this particular zone, which is an area of liquidity, let's say you enter right here and you put your stops above that point. The next area you're looking to get out is the next area of liquidity. And where's the next area of liquidity? Is to the sell side because we're in a sell trend. We already have, for those of you wondering, we already have the first sell right here. So price retraces to an area of liquidity. So where is price going to move next? To the sell side. And what will be that next area of liquidity? The next swing low is going to be that area of liquidity. And where's the next swing low? Here, right here. This is the next swing low. So if you frame it right there, you are expected to get out of your position at this particular zone right here. So this is where you expect to get out of your position. So if you get out of your position around this particular zone, you won't get wicked out. Are you seeing that? So you can see the way price respected the whole liquidity flow. Price dropped into an area of liquidity, which is a previous low, which acted as support, as resistance rather, and price rejected subtly all the way to the sell side, attacking what another low right there. This is simple and classic market structure right there. It's simple and classic market structure. Price move from a lower high to a lower low right there, from a lower low to a lower high right there, and from a lower high at this region all the way to a lower low at this region. Very simple classic structure. And all you could use to frame your entry was waiting at an area of liquidity. I don't know if you could see that. So this is very, very simple. So I believe you can take this particular idea and go in to the forex market, frame your own particular and unique strategy on the particular market you feel comfortable, and start profiting. So I believe you find value into this video, hit the like button, hit the subscribe button, and see you in more videos.